On Point with Craig's Investment Partners.
The information provided here is general in nature, it's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. The US Federal Reserve left interest rates unchanged last week, so the upper bound of its target range is 5.5%. That's the highest since 2001, and it's where it's been for a little more than a year. It left financial markets in no doubt that a cut is imminent, though, with Chair Jerome Powell noting that one might be on the table as early as at the next meeting, which is in September. But will that prove too late? And did the Fed just make a mistake by not cutting last week? After all, inflation increasingly looks to be under control in the US. The Fed's preferred inflation gauge is tracking at an annual rate of 2.5%. That's the lowest since March 2021, and it's just 0.5% above the Fed's 2% target. The annualized 3-month average has fallen to just 1.6%, with many forward indicators suggesting that this disinflationary trend will continue. Many would suggest this already justifies a rate cut, especially when one considers the lags in monetary policy changes taking effect. A soft landing is always the goal when a central bank embarks on an interest rate hiking cycle to knock inflation on the head, and while there's no official definition, that usually means getting prices under control without causing a recession or a major economic slowdown in the process. To achieve that, policymakers need to ensure that unemployment doesn't rise too much, even though they're actively trying to constrain activity. And that's a very difficult needle to thread, one which central banks only have a mixed track record at best of doing. There are a few exceptions, such as the US hiking cycles of 1984 and 1995, but most of the time, when interest rates rise sharply, a recession follows. So, a key to the success of achieving a soft landing is getting the timing of the eventual easing cycle right, and that's no easy task. You cut too early and then you appear soft on inflation, potentially risking a re-acceleration. You cut too late and the economy will suffer more than is necessary, increasing the likelihood of recession. Right now, it's the latter that is worrying investors. These concerns came into much sharper focus in the days following last week's Fed decision after a string of weaker economic data, in particular the July jobs report. We saw a surprise jump in the unemployment rate to 4.3%. That's the highest since October 2021, and it's well above the 54-year low of 3.4% from early last year. Now, that triggered a closely watched economic indicator called the SAM rule, which is named after economist Claudia Sahm. Now, that suggests that if the 3-month average of the unemployment rate rises just 0.5% from the low of the prior 12 months, then the US economy is in recession, or probably very close to it. There's never been a time that this has happened since 1945 without a recession occurring. And the SAM rule has never given a false signal. So with a 100% hit rate across those past 12 recessions, you can see why investors took notice when it was triggered last week. Despite that impressive record, it doesn't guarantee that a US recession is on the cards. Claudia Sahm came up with this in 2020 when she was working at the Federal Reserve, and it was never intended as a forecasting tool. It was something to help policymakers react more quickly and to be able to send out stimulus checks automatically. She herself has downplayed the recession talk in recent days, and she's pointed out that high immigration in the US and lasting aftershocks from the pandemic have distorted the numbers slightly. So while the speed at which the unemployment rate has risen is cause for concern, those issues might have artificially magnified the increase. But still, the Fed should be taking notice. Inflation is already headed toward its target, and meanwhile, cracks are starting to appear across other parts of the economy. A US recession is not upon us, but the risks of one have increased slightly. To improve its chances of threading that needle, I think the Fed should have probably cut last week rather than waiting until later in the year. Let's hope that doesn't prove to be a policy mistake that the Fed and we regret.
For more insights, visit craigsip.com.